Hello students and welcome back. Today's topic is stress testing. And when I say stress, I mean financial stress. Financial stress in most general terms can be considered as an interruption to the financial markets. And we cannot make this any more specific than that because no two scenarios of financial stress have been seen to be exactly the same. They do vary to some degree, and these degrees really depend upon various financial phenomena. With this definition of financial stress, let's see what is going to be covered in this topic. Once I have explained to you the various phenomena that cause financial stress, I will take you through the steps involved in stress testing. We will also look at the framework for developing scenarios in which we will look at revenue drivers, cost drivers, and leveraged balance sheets. Then we will look at the various conditions that can lead to financial stress, and these conditions can be segregated into internal, external, or environmental. We will also touch upon the result of a financial stress on commodities. I think we will be able to cover just this much in today's lecture. In the next lecture, I will take you through the practical version of stress testing and we will go through various scenarios. We will see how the models of the stress testing are built in various different scenarios such as bull markets, bear markets, or just the base case market. What all these mean are also going to be covered in the lecture. So let's begin with the phenomena that lead to a financial stress. Economists tend to associate certain key phenomena with financial stress. Now, the relative importance of these phenomena may differ from one episode of financial stress to another. However, every episode seems to involve at least one of the phenomena that I'm going to talk about. Now, one common sign of financial stress is increased uncertainty among lenders and investors about the fundamental value of financial assets. The fundamental value of an asset is the present discounted value of the future cash flows, such as dividends and interest payments. The increased uncertainty about these fundamental values typically translates into greater volatility in the market prices of the assets. Another form of uncertainty that often increases during financial crisis and contributes to asset price volatility is the uncertainty about the behavior of other investors. How are the other investors going to behave? In case of a panic situation, even if you want to hold on to your assets, if all other investors start selling out, then the value of the asset drops drastically. A third common sign of financial stress is an increased asymmetry of information between lenders and borrowers, or buyers and sellers of financial assets. Asymmetry of information is said to exist when borrowers know more about their true financial condition than the lenders, or when sellers know more about the true quality of the asset that they hold than the buyers. Information gaps of this kind can lead to problems of adverse selection, boosting the average cost of borrowing for firms and households and reducing the average prices of the assets in the secondary markets. A fourth common sign of financial stress is a sharply decreased willingness to hold risky financial assets. Such a change in preference will cause lenders and investors to demand higher expected returns on risky assets and lower returns on safe assets. These shifts in preferences away from risky assets and towards safe assets are often referred to as flights to quality. The result is to widen the spread between rates of returns on the two types of assets and increase the cost of borrowing for relatively risky borrowers. A final sign of financial stress is a sharply decreased willingness to hold illiquid assets. An illiquid asset is one that the owner cannot be confident of selling at a price close to its fundamental value if faced with sudden and unexpected need of cash. In some cases, an asset is illiquid because the secondary market for the asset is thin. so that selling a substantial amount of the asset has a large effect on its price. Talking about financial stress, you must also understand the link between stress and past data. All business enterprises, when looking at their financial evolution, look at their own past data. This past might show a very good picture of the enterprise and is no doubt based on reality. However, the past is no indication of the future. Statistics of the past is based on events that occurred in the past. Certain events that never occurred in the past can and do occur. Therefore, it becomes very difficult on the basis of past experience to calculate the value of expected loss of an event which has never occurred in the past. And yet, such an event, unprecedented in history, does take place every now and then. Now let's move on to the steps in stress testing. Stress testing has 5 important steps. Let's go through them one by one. Scenarios involve thinking on the lines of what if, such as what if the sales dropped by 20%? What if the product of the company suddenly lost its appeal? What if input costs went up by 20%? What if there was a 10-day strike in the supplier's plant? Scenarios therefore involve creative thinking. And in developing scenarios, one must not be trapped by the experiences of the past. One must think beyond the obvious. In this step, it is necessary to develop a number of scenarios. Robust scenario development may require the analyst to think of all possible situations. This may include situations that may be highly improbable. It is important to note that developing scenarios should be done without restraining oneself. The consideration of scenarios and their impact is a different aspect than that of generating scenarios. The next step is to apply stress. Now, stress can be applied in 2 distinct methods. First, stress can be caused by a scenario of extreme possibilities. For example, consider a scenario in which the most important supplier to an enterprise shuts down permanently. This can cause an extremely stressed situation for the enterprise, and the company can face a severe production crunch. Second, stress can be caused by a convergence of scenarios. Each on its own might not have been threatening. In combination, however, it may create stress. For example, in a currency crisis, the government may place an embargo on payments to be made in foreign currency so that foreign suppliers might not supply components. At the same moment, if the local suppliers have a shutdown at the factory or a fire or any other such disruptive event, then production can be completely stalled. The next step is impact analysis. Here you apply the stressed variables to the business of the enterprise and assess the financial consequences. So you ask yourself questions such as, what does it take to do the business? Can it still meet its obligations? Can it stay solvent? The next is probability analysis. While this can be done in a highly mathematical fashion, it might be sufficient to assign subjective measures like highly likely, less likely, and so on to get a sense of what might happen. Some estimates can be allocated to each subjective measures, such as highly likely may be given a weightage of say 30%, and a highly unlikely event may be given a probability of 1%. Finally, you have to look at the expected value of an event. Multiplying probability estimates from the 4th step with the impact analysis in the 3rd step gives a reasonable estimate of the financial impact, which can be used to assess the ability to meet commitments. Having looked at the steps in stress testing, let's move on to understanding the framework for developing scenarios. Now, this is a very simple matrix which gives you an example of how scenarios can be developed. This matrix helps develop scenarios which are in fact relevant to the context of the organization. For instance, if a company has no leverage, there is no benefit in developing scenarios that indicate stress in the borrowing environment such as interest rates and so on. Let's go through each of these elements one by one. First, let's look at the revenue drivers. In a fundamental sense, the revenue of an enterprise is always the starting point. It is the reason that the enterprise exists at all. And the revenue of a company is a function of two things. First, the size of an industry and its market share, which comes out to be sales into sales price. Using this as the basis for developing scenarios, we can project three possibilities: that the demand within the industry slumps, that is, the industry size shrinks. That which occurs to the industry will not leave the enterprise unaffected. If the company is involved in tape recorders as a business and there is a shift in demand to digital recorders, then the slump in the industry will cause a slump in the enterprise. The second possibility is that the share of the enterprise slumps. There are enough cases of an industry going through growth but a particular company losing share of the market. Kingfisher Airlines in India is one such example. Such losses in the market share can come from a variety of factors. Scenario building can be done without considering the factors. However, having factors in mind will help in assessing probabilities later on. Moving on to the third possibility, it considers sales price. That is, competition can cause pressure on sales price. A scenario can therefore be developed such as an industry situation or a market share situation to see whether there is a slump in the price that the company could potentially charge its customers. Let's move on to cost drivers. Costs, if they go out of control, can damage any organization significantly even if the revenues are intact. To build scenarios associated with cost, it is necessary to have a list of items of the cost which is typically available in the income statement. Materials which are input to the production process are the ones that are most frequently considered. Scenarios are self-evident. What if cost of materials go up, for example? However, each line item of cost can throw up similar scenarios. What if labor cost go up significantly due to renegotiation in wages? In order to consider the cost which are truly significant and meaningful and develop scenarios only for those, a DuPont analysis is most helpful. DuPont analysis is the analysis of return on equity, which can be found in more detail in one of the financial statement analysis topics. While doing DuPont analysis, each line item is worked out into a percentage of sales. Those which form a larger percentage should be focused upon rather than those which are a smaller percentage. A price shock to these significant line items would be a good scenario to work out. Finally, let's come to the balance sheet. Companies that have loans are subject to the impact of interest rate scenarios, which are leveraged balance sheets. Interest rates, if they go up, will significantly dent the company's ability to service its loans. This is especially true of companies which have a low interest coverage ratio in the first place. However, it could be that not all loans are sensitive to the interest rates. Fixed rate loans, for example, will be impervious to interest rate changes. It will have no impact on interest cover. Loans on which the rates are set periodically or variable interest rates are directly linked to market rates will show an immediate impact if any rate changes. Scenarios can therefore be developed which can create an interest rate shock, and the impact of that on the financials of the organization can then be gauged. One must remember that for companies, whether leveraged or not, if there are plans to raise capital, there is a possibility of turmoil in the market spoiling those plans. Let's move on to understanding what these columns are for. What do internal, industry, and environmental considerations mean? Not all scenarios which can impact an organization need be environmental. It helps to think at three different levels while building scenarios, which are internal considerations, industry considerations, and environmental considerations. Internal considerations may impact the company alone. Others in the industry or the economy may remain untouched by such events. For instance, a catastrophic fire can destroy the entire production plant of a company. It will have impact only on that company and on no other peers. Other such scenarios can relate to the regulatory action on the company, ban on its products due to safety, health, or other considerations, One such example recently has been a Nestle product in India, which is Maggi. And lastly, there could be legal cases. And finally, there could be certain legal cases against the company. Let's move on to industry considerations. Events that occur in an industry will not leave a company from that industry untouched. Scenarios associated with an industry are relatively easy to visualize. It affects everyone in the industry, no doubt, but it will do so to varying degrees. To what extent is the company that the analyst is focused on likely to be affected? This is a factor of the unique business structure of the particular company. For instance, the government bans the export of sugar at a time when international prices are attractive. It affects the profits of the industry as a whole. However, a particular company which did not have an export-led strategy may be less impacted than the ones that did. Similarly, when the government decides to ban tobacco, then a company which only deals in tobacco products compared to another company which had tobacco products as just one line of business. Let's move on to looking at environmental considerations. Nowadays, the environment includes not just the domestic environment but also the global economic environment in an interconnected world. Some of the considerations in scenario building based on economic considerations are political or social turmoil, extreme economic shocks such as increase in energy prices, an exchange crisis, disruption in shipping and logistics, or the more recent event that has happened, which is the tumbling of oil prices globally. And finally, there could be certain global events with international and local impact, and the falling oil prices that I talked about is one of this. Now, all of these three categories translate to impact only in terms of the key drivers seen in the financial statements of the company, which I also talked about on the previous slide. Let's move on to looking at the stressed scenarios in case of commodities. The impact of volatility in commodity prices has to be seen in two distinct ways. First, and the usual, is to understand the impact on input costs, as a commodity may be associated with the cost drivers in the income statement. The second is on how the movement of commodity prices impacts those companies whose products are closely linked to commodity prices. In particular, scenarios can be developed where the input was purchased at a higher price, and by the time the product reaches the market, the commodity price has collapsed. The company will never be able to sell its product at the true or profitable price. The following stress assessments are more important from commodity perspective. Let's talk about the first one, which is supplementing the stress test for risk reporting. In this, you need to process a static set of stress scenarios consisting of extreme price movements, correlation, coupling and decoupling, and liquidity decreases on a recurring basis. Make sure that the associated monitoring of stress test outcome is a key element of the risk governance framework. Second, you must consider market liquidity. Regularly, you should evaluate the market liquidity of each position. Asset-backed traders can hold positions that are more than 100 times the daily transacted volumes. As a result, any qualification of risk can be significantly distorted if the liquidity of a trading positions market is not taken into account. Then you apply proven methods. That is, you identify key historical incidents that had a detrimental impact on risk drivers and use them as inputs for standardized stress scenarios that are evaluated on a regular basis. You must also conduct reverse stress tests. That is, you examine the level of loss that would pose a significant threat to the trading organizations. Such a critical loss could result from occurrences ranging from missing annual performance targets to traders' reputation being damaged because they could suddenly trigger a need to hold a higher level of collateral, for example. Finally, you define the combined stress for commodity price developments and correlations. Trading organizations increasingly need to develop stress tests and more sophisticated risk aggregation methodologies that take into account risk related to not only commodity price fluctuations but also alterations in their correlations. And that brings us to the end of today's lecture. In the next session, I will take you through the various scenarios in different economic environments. Goodbye till then. Looking forward to seeing you in the next presentation.